All right, good afternoon, everyone. Thank you for joining us today for our kickoff of 2022, our Cornerstone Wealth Planning and Market Update. Happy New Year to you all. I hope it's not too late to say that. We're in the end of January, but we're still going to go with that, Cliff. So we're going to stay with Happy New Year, everybody. As you all know, I'm Jeff Carbone, Managing Partner at Cornerstone Wealth, again, joined by Cliff Hodge, our Chief Investment Officer. So welcome, Cliff, and thank you for your time today.
Happy New Year to you too, Jeff. Great to be with you.
There you go. Let me start. I'll go over the agenda. We're going to start today certainly with a review and a look back to 2021. We'll go an overview of the markets and the economy, what we see as the themes for 2022. So you're going to hear us talk about the inverse relationship between liquidity and volatility. We're going to talk about the geopolitics that are certainly out there, the midterm elections that are adding some uncertainty. And in the times of heightened uncertainty, we'll look into talk about how do we add certainty to the investment portfolios. Of course, we'll move on just to the not only the outlook, but the positioning of what we're doing today. And then lastly, I'm just going to wrap up with a few financial planning updates and some ideas. Again, we are recording the presentation, so if you need to hop off or really if you want to share it, it will be posted to our website. We'll be on our YouTube channel in the next few days. So again, please forward it on friends, family, co-workers, and let them take a listen. Also, a reminder that we will try and take a few questions at the end of our session, and there is a Q&A section at the bottom of your page. So send us any questions, and we do have a couple questions already that came in. Let's get started as we reflect back over the last year, Cliff, and really the last, let's say the past couple of years. Another strong year from the equity markets. Happens to be the third year in a row that we've seen, again, strong positive returns. I went back and I received something from the other day from I forgot if it was Lincoln or one of the another firm, talking about how in the last 50 years, 40 of those 50 years, the markets have been positive. So again, when we have bumps like we're in, 80% of the time, the markets tend to be positive. So again, those are pretty good odds. Also, again, the end of 2021, so 12/31/2021, marked the stock market's worth at $53.4 trillion. So a major, big amount of money. And to put it in perspective, the U.S. economy is about 23.2. So the stock market about almost 2.3 times greater than the U.S. economy. We started 22 with a big reminder. Not everything, this market does not always go straight up. We've seen that over the last few years, or really post-COVID, or not that COVID is behind us, but the post-COVID drop back in that March, April, May timeframe. But we've seen the pullback begin early here in the year. We could look at the valuations that we've seen that have grown so significantly, the fears of inflation that remain out there. Yesterday was a big day. We're looking for what action or what was the Fed going to do. Powell started, with the notes were good. Speech, not so much. When he took questions, kind of threw things off. Markets did not like what he was responding to. Of course, the variants of COVID, what's next? We've had Delta, Omicron. Is there another one soon to follow? We shall see. So that is not behind us. That's just a new normal. Again, Cliff is going to go over the political global issues that have arisen, and of course the elections that will be coming up. So a lot of catalysts out there that we're always looking to follow, find out, give some thoughts. So Cliff, without any further ado, I'm going to hand it over to you, and let's start with a deeper dive back into 2021.
Thanks, Jeff, and thank you for that awesome introduction. You highlighted a lot of the catalysts, a lot of uncertainty, and that just brings me back to one of the key points that we want to hammer home today is that in times of uncertainty, the macro environment, the political environment, the virus as well, we want to add certainty to our portfolios. And so we'll talk about some of the ways that we're doing that. But before we do so, we'll start off as we always do by taking a step back, looking at from where we came to then determine the likelihood of potential paths forward. 2021 was a great year for risk assets. Global stocks were up nearly 19%, led by U.S. large caps, the S&P and the NASDAQ, both up in the high 20s. International was up more modestly at 11.5%, 12%. Small caps up 15%, and EM was really the only major equity cohort which was down in 2021, being down nearly 4%. On the fixed income side, high quality bonds struggled. So looking at the AG, which is like the S&P 500 for the bond market, investment grade corporates, both nearly down 2%. But more speculative areas of fixed income like high yield bonds up nearly 4%, preferred stocks up nearly 7%, worked out pretty well. So in short, 2021 in a nutshell, the more risk that you took on, the better your overall returns and the better your overall experience. And while that's great and we'll take it when we can get it, we think that is not likely to hold up as we move through 2022. One of the primary reasons being that there was a massive amount of both fiscal, which is this legislative and administrative buckets, nearly $6 trillion, nearly $7 trillion in fiscal stimulus, alongside another $7 trillion in Federal Reserve stimulus and balance sheet expansion. So we had about 30% of our annual GDP being injected into the markets in the form of this excessive liquidity. Which ties back into that first takeaway, Jeff, that what once was a tailwind is now going to become a headwind as we unroll some of these stimulus packages. From a market perspective, we ended the year at about 21 times earnings, and now with the little bit of volatility that we've had to start off the year, this has actually come down a little bit more. We're down here right below 20 times earnings for the S&P 500. But what I wanted to draw folks' attention to here is that over a 1-year period, valuation is basically irrelevant for understanding the path of market returns at R squared of 3%. But the distribution is very wide, right? So you've seen years where you've had a 40% return, years where you've had a down 30%. So very wide range of outcomes. Again, this is that uncertainty that we talk about on the kickoff of the deck here of the presentation. But what is more certain is that over the longer run, so this is over 5-year returns, and I'm sorry, this is PE ratios here on the x-axis, returns on the y-axis. So over a longer run period, valuations are extremely important. And what that tells us is that over the next 5 years, it's likely that returns are going to be lower for equities until we get a bit of a valuation reset. Very similar for fixed income as well. If you look at where we are from a yield perspective, here where we are on the AG 1.75. You can see the returns here as well. But on the right-hand side, we like to highlight this yield and duration relationship. So duration is just a measurement of how sensitive a bond or a bond index is to a 1% rise in interest rates. And as you can see, if you look at the US AG here, a 1% rise in rates, which is essentially what the market is pricing in for 2022 at this point, you could see a total return of as high as -5%, total price return of nearly -7%, just all else being equal, just a 1% shift in the yield curve. So we can see that the setup for traditional assets is likely to be a little bit challenging. Now, this does not mean that you want to abandon your bonds. They still do provide diversification benefit and, more importantly, risk reduction compared to an overall equity portfolio. But this is really why these last 2 slides are why we've been pounding the table on alternatives. And so we'll continue to discuss that further. But if you have not yet spoken with your advisors about the alternatives portfolio, we would encourage you to do so. So with that, Jeff, I'll hand it off to you here and have a sip of water. I think you're on mute. we're a little rusty. All right. Well, Jeff's still on mute, so I'll keep moving forward.
Sorry about that, Clip.
That's all right. That's all right. It's been a while since we've done one of these, so
no, we're trying to do something different today. So, but no, we look back at 2021. I know you went through a fair amount, but it's not what have you done? What have we done? It's what are you going to do for me, right? So let's talk about what's happening for 2022. And kind of look at what are we talked about, or you showed in your opening here with the agenda, the volatility and liquidity and the geopolitics. But let's start with the relationship between liquidity and volatility. I think that's a great start.
Yeah, I think that's really the key theme for 2022 is that it's going to be a year where tailwinds, i.e. stimulus, will now become headwinds. And so just a quick reminder of where we are coming from. Nearly 30% of GDP being pumped into the economy from a stimulus perspective. But the game has changed. And now we're going to have to experience some withdrawals of all this excess liquidity. And so to see why that's important, first, we'll start with the monetary aspect. So this is, the Federal Reserve and the global central banks. Lot going on with this graph here, but the important thing to realize is that there's correlation between the size of the balance sheet, which are the bars, and then equity returns, which is this blue line. So as the bars are higher and expanding, returns tend to follow suit. But then as we cross the threshold of the zero bound and go negative, returns are likely to follow suit to a degree as well. Doesn't mean that we're calling for negative equity returns for the year. We are not. We think high single digits is probably pretty reasonable for 2022. But the path in achieving those is likely going to be much different than what we've experienced. So tightening from a balance sheet perspective, also interest rate hikes. This is what really got the market's attention yesterday. So I pulled this before the meeting. The market's now pricing in 4 25 basis point hikes in 2022. And then as of this morning, post the press conference yesterday that Jeff mentioned, it's now up to 5. So the speed of the tightening cycle is what is really important and what, in my estimation, got the market's attention yesterday. And why I say speed is important. So what we did as students of the markets and students of history, we went back and looked at various tightening cycles going back to 1946 to see what we could deduce from history about what the potential paths forward may be. And what we found is that on average, stocks actually do okay when you look at breaking these down in different regimes. So on average, equities were higher after tightening begun to the tune of roughly 5%, but speed really matters. The other thing that we found interesting is that multiples on average also contract. So think price to earnings ratios. We've already begun to see some of that as now we're down below 20 times next year's earnings estimates. But again, we really think that the speed and some of the comments from Fed Chairman Jerome Powell yesterday regarding having a lot of room to tighten and looking at getting the path of monetary policy back to a more normal regime in a quick period of time is really why we saw a lot of the agita in equity markets yesterday. And I think this is a very huge signal. Because we are entering a new regime where the Fed likely will not automatically have the markets back on every hiccup. They've been very clear with their communication that now fighting inflation is in fact the highest priority, and so that maybe less of a focus on the growth side. So that's the story from a monetary policy perspective. So we'll be watching the speed of how quickly they hike, how quickly they signal further hikes, and then balance sheet normalization. But then from a fiscal perspective as well, there's going to be a drag on GDP growth from the fall off in fiscal spending, especially even now that the Build Back Better plan, it looks like is not going to come to fruition. that will probably help from an inflation standpoint because we're not throwing more money at our problems. But no question will be a drag on GDP growth to the tune of roughly 1.3 trillion. And then I highlighted that the bulk of that year-over-year decline is going to be concentrated in the second quarter. This is important. And for those of you who have been following along at home, reading any of the commentary, we know that using our quadrant framework, which again is all based on rates of change in GDP growth and inflation, that the market has been pricing in, or our models have been predicting a steep quad 4 in second quarter of 2022, which again, if you start kind of connecting some of these dots, right, along with Fed policy, what's likely to be happening from a growth and inflation perspective, you can see why the window of risk has likely opened up and what the markets are priced in the process of pricing in as we speak. Now, that being said, I don't want to be all doom and gloom. You know, there certainly are some headwinds that are going to be that investors are going to be facing in 2022. However, from a growth perspective, we're expecting really strong growth above trend. Right now, the median estimate for consensus forecast for GDP growth is 3.8% in 2022, coming off 5.6 in 2021, which is one of the strongest years we've seen in the past 50. But still above trend, above average growth, likely settling out closer to trend in 2022, 2023. This is very supportive for risk assets, especially those shorter duration value kinds of stocks. Not necessarily the high growth and the momentum source of stocks, but just some of those types of factor exposures will typically do well in a higher growth environment. But again, here I wanted to highlight the dispersion and the uncertainty, right? Where you've got the highest estimate nearly 5% GDP growth, the lowest estimate nearly 1.5%. So that dispersion of about 3.5 GDP points is much wider than what we experienced last year. So again, that uncertainty is rising. But all in all, supportive of equities. Speaking of equities, how low can we go? I know that's the question that a lot of is at the top of mind of a lot of clients and some of our advisors. Question I've gotten quite a bit here recently. And we look at the potential, the probability of where we base and move forward in a couple of different ways. First, I'll highlight some of our sentiment indicators that we track. And I will say, our short-term sentiment indicators are pointing to a pretty good likelihood of a relief rally really here at any point. So if you look at some of the things like the bull bear surveys, you look at put call ratios, which are what's going on in the options market. You look at implied volatility premiums in the options space as well. We're getting to points where at least historically have marked, short to intermediate term bottoms. Doesn't necessarily mean that, we can't drift a little bit lower here. But from a sentiment perspective, we're seeing the things that we need to see in order to potentially find a bottom. The other way we look at where we can go is from a valuation framework. So this is a pretty simple framework which pulls in earnings expectations. These are our consensus for 2022 at $223 a share. You kind of look at that up here on the x-axis. And then we look at corporate bond yields. So this framework ties equity valuation and interest rates together because that's really been the big driver here of these moves recently. And so as of today, we're right here at this 3% on BBB corporate bonds. And we're at about 220, 225 on earnings per share estimates. So that puts us at a fair value of about 4,500. Now we closed today at 43.26. So from a fair value perspective, based on where we are today, we've actually overshot where we should be from a valuation perspective. That's not surprising. In the short term, markets often do go to extremes before we find some equilibrium. But I also wanted to highlight, perhaps a worst case scenario as well. So a lot of the movement in credit yields are kind of getting in front of the Fed, signaling that they're going to tighten. Let's just say spreads blow out as well. We get down to roughly 400 basis points on a triple B bond yield. And let's just say earnings maybe come in a little bit lighter than expected, that 223, so maybe 215, 220. That gets us down to around a 3,800 level for the S&P 500. I would say that that's not the probable outcome, but that is a bear case scenario where, at that point, we get down to that 3,800 level, we would be looking to risk back up our portfolios in a pretty meaningful way. And so, Jeff, I don't know if we've had any questions come in on that, but thought we may try and head that off. But that's really the quick and dirty on what we're expecting from markets and macro in 2022.
Well, again, there's a lot going on, Cliff, and I know again, just the Fed, as you spent, the tightening, the game is changing from loose money to much tighter parameters of the dollars. Again, it's not to be the bearer of bad news. It's just reality, right? We've had really strong markets. It's not what's happened. It's really the preparation and helping meet expectations, right? We can't expect every year for 10, 12, 15+% gains in the market. So it's just reiterating what we're seeing and those tailwinds becoming the headwinds and changing, a little bit of a changing cycle. So in addition, let's talk about the, midterms and certainly the geopolitical issues. And I know we did have a few questions on that, and certainly Russia building up its against the Ukrainian border. So let's go into those.
Yeah, thanks, Jeff. And that's the other hot button topic at the moment is Russia and Ukraine. What may happen there? What are potential knock-on effects for equities and commodities and markets and so on and so forth? And our take on the geopolitical is that, first and foremost, we have no edge in trying to get inside the minds of communist dictators regarding things that they may do. What I can say is that typically, historically, a lot of these geopolitical events just result in short-term noise. You get some volatility, and then we're able to kind of go on about our day, assuming that these don't reach kinetic warfare kinds of scenarios. So again, what do we like to do when we get into unfamiliar environments? I like to look back at history to kind of understand what may have happened before in other scenarios. And so the one that we found that was most apropos is the annexation of Crimea, which happened really late 2013, early 2014. So the S&P 500 is this white line here. We had about a 6% drawdown when Russia invaded Crimea, which was very brief, and then we went on to make new highs. Very similar story in oil as well. Oil prices came off about 9% before rallying nearly 13 and going on to make new highs there as well. And then Treasury yields fell off pretty rapidly, kind of a mini quad four, if you will, where yields fell from about 3.25 down to 2.7 before moving back up and basing. And so, I find that while we don't know how things are going to work out, I mean, our base case is that we will begin to de-escalate, that there's not going to be an all-out war over Ukraine. Obviously, anything can and will happen, but it's just good to have some historical perspective about some of these geopolitical events. What we are more focused on in 2022 and here in the U.S. is midterms, and so again, go back to history. What can we glean? Well, we looked at S&P returns since 1931. We pulled out any year with a midterm election and basically smashed them all together, compared those to other years, and there were really two key takeaways that we found. So one, on average, midterm years produce lower overall returns, roughly 5.5 versus 9 in all other years. Higher volatility, as you can see from some of the squiggly lines here on the chart. But then two, returns that did accrue in midterm years were typically backloaded. So we were flat to down on average up until late October, and then we really rallied going into the latter part of the year. Doesn't mean that that's going to happen, that it's going to follow this pattern to the T. But again, as what we do is we think about all these different pieces, all these different moving parts, right? So the Fed, what's happening with valuations, what's happening with the macro, what's going on with the quads, what's going on with midterms. They're all kind of pointing to this same picture and this same mosaic. Lower returns, higher volatility, and get ready for a little bit more of a bumpy ride, which is what has been playing out to date through the month of January. Doesn't mean recession, doesn't mean we're expecting any sort of 30, 40, 50% drawdown in the S&P, nothing like that. I still do think that we're going to end the year positively. But the ride is maybe perhaps not going to be as smooth, which is why then we talk about risk mitigation via asset allocation and via the security selection, which all flows through into our process. The other side of the graphic here, as of now, the betting odds and the polls are pointing to a Republican sweep in the House and Senate. This is, as always, subject to change. But what I will say is if this is the way that it plays out, it would give me more confidence in this picture in the back half of the year, because at that point, markets would start thinking gridlock, which is typically good for risk returns. So a lot coming at us, Jeff, a lot of unknowns out there, but in a lot of different things that we're watching. But we're just taking it one day at a time and taking things as they come and looking for opportunities that present.
Again, Cliff, as you said, a lot going on, right? Geopolitical, the Fed, whatever. There's a lot. So the midterms, even though it's in November, it starts to heat up and it's already heating up. So, the conversations are, what can change. Thank you for sharing the slide in terms of, gridlock is not bad for the markets, may not be the best for our governmental system and passing of laws, but again, does markets react with not a lot of change. So you also mentioned risk mitigation, right? So again, with all the uncertainty that's out there, it doesn't mean that, as Cliff said, that there's recession. Or recession is, on the early horizon. We will go through a cycle of recession as the numbers continue to change. But again, it's not there today. So the risk mitigation that you continue to take, dollar cost averaging into the portfolios. Cliff has already done a lot with reducing risk by adding more higher quality positioning, and he'll talk about that in just a second. So there's a lot of behind the scenes that are being done to do that already. So Cliff, let's talk about the positioning and what the portfolio positioning at this point.
Yeah, so there's a lot going on, Jeff. Given all of this, we get questions. What do we do? How can we prepare for our retirement? And I like to say that in uncertain times, like what we're experiencing now, we seek a bit more certainty with our investment portfolios. We really want to lean into purpose, and we really want to control the kinds of risks that we're wanting to take on. Just make sure that we're very deliberate with our portfolio construction. So earlier we mentioned alts, and I would say that without hesitation, this is the number one portfolio pivot in my estimation for 2022, and the number one way to control risk. This graphic does a great job telling the story in a pretty easy to read chart. So returns here on the left, volatility, right, which is a measure of risk on the x-axis here. And so you can see by adding exposure to alternatives in your portfolio, and this is just a hypothetical example, made up of hedge funds, real estate, private equity, so on and so forth. not only do you reduce your overall returns, so you shift higher, but you shift to the left, and which is lower on the risk spectrum. So especially given the macro setup where valuations are still high, interest rates are still low, but we expect that they will be rising. Filling out that third leg of the stool, equities, fixed income, and now alternatives, we think is a really great way that we can control risk, enhance returns at the portfolio level. And so to be balanced, that's really why we the case for alternatives. But what's the other side of the coin? Over short periods of time, they can be a drag on performance. There are often higher fee structures associated with the alternative investments. Not that our fees are any different, just the complexity that gets involved can lead to higher fees. And then importantly, liquidity as well. Now, there's only one fund in our alternative portfolio that has any sort of liquidity restrictions. It's quarterly liquidity rather than daily. That is just something to be aware of, because there's always a bit of a trade-off. So we think about risk, right? How are we deliberate? How do we control risk? And by and large, there's kind of two ways to do it, which I like to think of directionally. So horizontally, right, which is your asset allocation mix. So how much do you have in short-term bonds? What's that purpose? Capital preservation. Or how much do you have in unconstrained best ideas? This is where you're trying to get some growth, for example. And then what are your diversifiers? So what kinds of things do you have in there that will zig when other parts of your portfolio zag? This ties into the financial planning aspect of our business. When you spend some time with your advisor and you go through or update your financial plan, this horizontal risk mitigation is really the key determinant, the largest determinant overall of your portfolio and of your risk tolerance. But the other way to control risk is vertically. So that's within asset classes. So within equities, do we favor large caps? Do we favor small caps? Do we favor high beta, things with high debt loads? And so, really the key takeaway really across the board is that, we've been active in reducing the overall risk within the asset class level. And we're not really swinging for the fences anywhere right now, but we're looking to bring down those levels of risk incrementally. So we're never all in, we're never all out. We're not selling everything and going to cash. We're not market timers, but we do believe that risk mitigation is a valuable component over time that can add to your performance, and then also reduce, smooth out the ride to a degree. So what does that mean in equities? We like things that have high quality, so high returns on capital, high profitability, low volatility, things that are lower beta, that don't necessarily move as much as the equity markets do. We also want to have some combinations of cyclical exposures and some combinations of things that can benefit in a growth slowdown. And then we're also carrying a little bit of cash in our tactical portfolio to be able to take advantage of opportunities. On the fixed income side, similar story here. We don't want to take on a whole lot of duration or interest rate risk with our fixed income portfolios. We're looking for conservative styles and more aggressive asset classes so that we are very deliberate about the risks that we are taking on, and we're not overloading our portfolios with credit risk or equity risk, for example. And then lastly, alternatives. So making sure you've got an allocation among all three of these asset classes. Again, not trying to swing for the fences here. Not private equity. We're not looking at cryptocurrencies or anything along those lines. But really strategies that have little or no correlation that can help you smooth out that ride. And again, I'll highlight that this is our highest conviction asset allocation. When we think about the available universe. And so, Jeff, before we get to questions, I'll just summarize some of the key takeaways. Again, 2022 is going to be a year where tailwinds become headwinds. We expect lower overall returns, higher volatility. So buckle up and get ready for a little bit of a bumpy ride. Geopolitical and political headwinds around elections all add to the uncertainty and all give us a wider distribution of potential outcomes, which make forecasting, obviously a little bit more difficult. And in these times of heightened uncertainty, what do we want to do? Let's seek more certainty with our investment portfolios, emphasize purpose and being very deliberate. And we think, as long as we stick with process and are very deliberate about the things that we're trying to accomplish, that we will provide a much smoother ride and a better experience for our clients than just riding out all the volatility in the S&P. So with that, Jeff, I will turn it back to you. I know you've got some planning topics and there's some questions, and we appreciate everyone joining us this afternoon.
Well, again, thanks, Cliff, a lot. And we know it's a lot of information. There's a lot of data that Cliff always goes over. But again, I think the takeaways, again, that Cliff just shared, we know the headwinds becoming the tailwinds becoming headwinds. We're watching it, right? We're continuing to watch it because that, one of the questions, and I think you already went over it, Cliff, is, what are we doing to secure and protect those that are in retirement? Again, going back to the adjustments we're making, higher quality companies, bigger with higher cash flows. Again, I think that was, we may have answered that one already. One question that we did get was, we didn't really talk much about it, but maybe share some thoughts, Cliff, on inflation. What are we looking at the rest of 2022? And maybe, what the impact that it has on the equity markets or the stock market.
Yeah, that's a great question, and we skimmed over that one briefly here, but really that has to do with our forecasting models for the quads. And so our models are indicating that inflation is likely going to peak out here over the coming quarters and then turn back lower. Now, doesn't mean prices are going lower, and it doesn't mean that we're gonna go back to the environment from where we came, where you've got less than 2% inflation. But from a rate of change perspective, we will likely peak out and then move lower, but kind of level off at a higher plateau than where we have been before historically. And that's really important as you think about your allocations and you think about the kinds of things that you want to own. And the number one pivot in a rising inflation, and typically that's accompanied by a rising interest rate environment, is that duration characteristic, right? Which is that interest rate risk. So in fixed income, you want to lean out of things that are very rate sensitive. Things like long-term treasuries typically perform poorly in a rising rate environment. The ag, again, which is the S&P 500 of the bond market, it's made up of treasuries and investment grade corporates, will likely struggle in a rising interest rate environment, which is why we don't really have any ag-like exposure in our fixed income portfolios. From an equity perspective, so depending on the regime, right, whether it's quad 4 or quad 1, which is where inflation both decelerates, certain things will work better in one environment versus the other. So if you think about it, compared to where we have been, things like value stocks, things that have current cash flows, dividend paying stocks, typically will work well in higher inflation environments. However, if you look at a day like today, where we kind of got a little bit of a mini quad 4 episode, sorry about that. Interest rates actually fell pretty precipitously today, and the yield curve flattened. So those are signals of quad 4, which is really kind of a more risk-off environment where you want to hold some cash, you want to hold things like low volatility, utilities, consumer staples, healthcare even works in that environment. So it's a bit of a balancing act, and you want to have exposure to things that are going to work in multiple environments. But hopefully that helps answer the question about how the inflation regime may impact asset classes.
Thanks. We got a couple more, Cliff, and we'll kind of wrap up with some planning here at a couple as quickly as I can. But I think we talked about one of the questions, of course, was about Russia and the saber rattling along the Ukraine border. I think we answered that. It will not be positive, maybe at least in the short term. Conflict, especially with a major power or individuals that may not be of all right mind, never bring good positive returns to the market. So I think we probably can answer that pretty easily. It's not going to, in the short term, probably pretty negative, and just to, hopefully diplomacy weighs out. We touched on this a little bit where David had maybe we brought up recession. Again, we don't see recession on the horizon. Cliff, I know you've shared information before about when recession, after interest rates start to rise, time frame of when recession could, could typically be called or expected. So let's talk maybe a little bit about recession.
Yeah, so recession, there are a couple of different definitions. I think the one that's most widely recognized is two concurrent quarters of negative GDP, so contraction. There's a couple of different ways to look at it, but it's prolonged economic downturn, more than just a quarter, typically at least 2 quarters. So you see things, you see income actually fall rather than grow slower or decelerate. It's really when a lot of these factors go negative and not just slow down, but you're actually contracting. So income, retail sales, like consumption kinds of data points going negative. One of the best indicators of recession, which we watch very closely here at Cornerstone, is the Treasury curve. So you may or may not be familiar with what the curve looks like, where typically your shorter term interest rates are lower than your longer term interest rates. Well, when we get inverted, or we flatten out or get inverted, which we're in the process of kind of flattening out here right now, short-term rates go higher than long-term rates. And that is by far and away the number one leading indicator of recession. We've not seen that yet. When that happens, it's typically on average about 18 months or so after the curve inverts. So, at this case, the very earliest we see recession being a threat is 2023. But again, we're going to be seeing above trend GDP growth for the next 2 years. So not really a concern at this point. Things can and will change, but where we are today, not worried about recession.
I'll wrap up here in another 5 minutes or so. But 2022 is, now who could think time goes quick. We're already a month in to 2022. New Year's resolutions always begin. I know I was talking with Cliff earlier, and of course, for 2022, the top New Year's resolutions were weight loss or getting healthier, getting one's finances ordered with number 3, and which was nice to see, spending more time with family and friends. So those were the top New Year's resolutions for 2022. So I'm going to talk. I figured I'd spend a little time on number 3, since we are advisors and financial planners. I'm going to, and let's talk. 401ks, IRAs, retirement accounts. Again, for 2022, they did increase the amount that we can contribute. Went from 19,500. It's now up to 20,500. There was no change on the amount if you were over 50 to do a catch up, but so that stayed at 6,500. So you are eligible to put in 27,000 into a 401k. For those that are, call it independent contractors or business owners that have a SEP or some type of defined contribution plan, that increased from 58,000 to 61,000. Of course, one of the most well-known IRAs, they didn't change this year. They stayed at 6,000 and the catch-up stayed at 1,000. So again, if you're over 50, you're able to put 7,000 for 2022. I bring these up, one, because it's a good time to review, look at increasing if you're not going to max out. If you can max out, we've got, again, 11 months to do so. We can get that done. But also, I know we hear it a lot from clients that they've got outside accounts or they forgot about an old 401k or an IRA, and it's got a couple, whatever, 25, 120, whatever the amount is, good time to maybe simplify, look at consolidating. A lot of our time at the end of last year or 2021 was spent around potential tax law changes. Well, all that time was for naught because no tax laws changed. So it was getting ready and preparing, and nothing passed. So tax brackets remained the same, starting at 10, 12, 22, 24, Omaha, 32, 35, 37. Feel like Peyton Manning. Capital gains, 0. If you're in the lower tax rates, 15 and 20, not including the additional Medicare tax. So again, no change on capital gains or tax rates. Although, there's still talk and they're still looking to make increases for higher net worth or wealthier clients. Another big part of what we were doing, not only taxes, was preparation for possible estate tax changes. That did not happen as well. So we've had the additional inflation kick in. So the gift that you're allowed, lifetime gift or unified credit, is now up to $12,060,000 per person, or $24,120,000 per couple, meaning, again, you can give that while you're living or up to that amount while you're living or at your death, and there's no estate taxes that would be owed. If you're over that amount, the tax rate did remain as well at 40%. So again, fairly high amount of taxes paid at one's death if you don't do proper planning. And bigger reminder that we may have escaped a few years, but in 2026, this does sunset and reverts back, automatically goes down probably to around 6 or 7 million. So a good time, review your estate documents, still a good time to continue to talk about estate strategies, review beneficiaries. It baffles us as advisors that we come across ex-spouses on retirement accounts or investment accounts. So make sure your beneficiary is in order. Powers of attorney, if a parent is now in their 90s, probably not the best choice for power of attorney. Although there's a lot of really strong 90-year-olds and that maybe they are better off, but a good time to review those documents. Also talk with your advisors. What the legacy for your family? What is the philanthropic goals you may have for your family? Good time to have a discussion about making sure your wishes for philanthropy as well as legacy are all going to be met. And then, lastly, Cliff mentioned earlier, lots changing. The game has changed. As we can see, the January effects started early in January and quickly did not continue because the volatility has increased. So we're seeing, we're making the changes. We've adjusted the portfolios prior to a lot of it was done prior to the new year. We'll continue to make adjustments here as the conditions change. But if they're, again, going to your 401ks or outside accounts, if we don't have full line of sight, so it's always a good time to review those accounts, stress test them, not against what happened in the past, but what could happen and what the conditions ahead. Is inflation rising or falling, growth rising, falling, all those factors, interest rates going up or down, stress test your portfolio. Cliff, we didn't talk about planning, process, and patience, but that does remain the key to providing that clarity and confidence, as we say, the cornerstone of your or our client's financial life. Want to thank you all for your time today. The reminder that this is recorded. It will be on our YouTube channel. We'll send it out here in the coming days when Ashley gets it done. Big shout. Thank you for Ashley for the coordination. We tried to change something up. I don't know if I'll do it in my office again. I can see the sun behind me. So I apologize about that, but wanted to change up a little bit. Again, we thank you all for listening. Thank you. Share that with your friends, relatives, coworkers. If there's any additional questions, just give us a call. But want to wish you all health, wealth, love, and happiness for the year ahead. Thank you, everybody, for listening today. Be well.